So let's talk about trading on margin, how to avoid these dreaded margin calls. So what we'll talk about is what is margin. I'll give you a very specific example. Then we'll talk about the advantages of margin trading. We'll also talk about the dangers of trading on margin. We'll talk about what are these so-called maintenance requirements. What is a margin call? It's something bad when it happens. So we got to talk about this and how do you respond to a margin call? And then we'll also talk about portfolio margin. So as you can see, a lot to talk about. So let's get started and let's talk about what is buying on margin. Or margin is basically borrowing money from your broker. That's quite interesting. You see, you can think of it as a loan from your brokerage because margin trading, as you'll see in an example here in just a moment, allows you to buy more stocks than you'd be able to do normally. Now, to trade on margin, you do need a margin account. You see, this is different from a regular cash account in which you trade using the money that you have in your account. Now, by law, your broker is required to obtain your consent to open a margin account. So the broker cannot simply turn your account into a margin account. Doesn't work with this. But you see, the margin account may be part of your standard account opening agreement where the broker asks you, what account do you want to open? Do you want to open a margin account and we will give you more money, or do you want to have a cash account? By law, an initial investment of at least $2,000 is required for a margin account, but some brokers require more. This deposit that you have initially is also known as the minimum margin. And once the account is open and operational, you can borrow up to 50% of the purchase price of the stock. Now, this is important. So let's just say that you would put $10,000 in cash into a margin account. So this means you can borrow another $10,000 from your broker. Now, you don't have to do this. It's basically like a line of credit. So you can borrow less or you can borrow not at all, right? So this is what you need to know. Now, the important thing is you can keep your loan or the margin as long as you want, provided you fulfill your obligations, such as paying interest on time. When you sell the stock in a margin account, it's pretty much like selling your house, right? I mean, at first, the proceeds go to your broker against the repayment of the loan. It's pretty much like a mortgage, right? When you sell your house, the bank is being paid first. Now, there's a restriction called the maintenance margin, which is the minimum account balance you must maintain before your broker will force you to deposit more funds or sell stock. And when that happens, it's a margin call, and we'll talk about this in a moment. But let me give you a very specific example first of what a margin is. Let's say you're putting $10,000 in cash in your margin account. Your broker will loan you another $10,000 up to, again, you don't have to. This means that you have a buying power of $20,000. Let's just do an extreme, and let's say with this buying power of $20,000, you are buying 100 shares of a stock that is worth $200. So this means that now you're using every single cent of your buying power in the account. But there's a reason why we are using this extreme here. Now, when you do this, $10,000 of this $20,000 is your cash, and $10,000 is the loan from your broker. And on this $10,000, you'll pay interest. Okay, so why would you even consider doing this and trading on margin? Now let's just start with the fun example first. Let's just say the stock rises by 25% from $200 to $250. What does this mean? Now your portfolio value is 100 shares that you have, right, times $250. So this means it is $25,000. Now keep in mind, these $25,000, your portfolio actually, you have a profit. It went from $20,000 to $25,000. So you have a profit of $5,000. Now, based on the $10,000, these were your $10,000. So based on your $10,000, that is a 50% increase because you made $5,000 based on your original $10,000. So that is pretty cool. If you think about it, the stock only rose 25%, but you made twice as much money because you leveraged your account, you used margin. Okay, so yay, this is the great news. But let's talk about the dangers of trading on margin. So now let's do the other way around. Let's say the stock drops by 25%. And it drops from, let's say, $200 where you bought it to $150. You get the idea. So what is your portfolio value? So your portfolio value is now 100 times $150. So that's $15,000 that your portfolio is now worth. So how much are you losing? Well, you had $20,000. Now you only have $15,000. So this means that you have a loss of $5,000. Now, again, based on your $10,000, this is a loss of 50%, even though the stock only dropped 25%. So as you can see, leverage and margin is a double-edged sword. Yes, you can make money twice as fast and you can lose money twice as fast. So let's talk about these maintenance requirements, these dreaded margin calls. First of all, this is where you need to understand we have something that is called the initial margin, and the initial margin is 50%. And what does this mean? It means that 50% of your total value of the portfolio can be margined. This is where, as we said, if you have a $20,000 buying power, so this means that $10,000 of this can be margined. And this is the loan from the broker. So now let's talk about the maintenance margin. Now the maintenance margin varies from broker to broker, but it's typically around 25%, could be 35%. Please check with your broker, right? So let's just talk about this, of what this means and what impact it has. So let me give you another example here, and we're still doing our $10,000 example. So we have $10,000 in cash, and we have the $10,000 loan from your broker, which is the margin, right? So this means we have $20,000. Now, let's say that our stock that we used in the previous example here, let's just say that our stock drops by 20% to $160, right? So again, what is now our portfolio value? So our portfolio value is now 100 stocks that we had times $160 is $16,000. So now the question is, okay, how we're doing here with the maintenance margin requirements? Well, this is where we have the $16,000 times we take the 0.25, which is 25%, means that the maintenance margin requirement is $4,000. Stick with me because this is important. This is what very few traders understand. So let's take a look at this. We have a $16,000 portfolio value, and we have a $10,000 loan that we received from our broker. And now we need to subtract, and this is important, the $4,000, which is the maintenance margin. Now, if we do this, how much money do we have left? Well, we have $2,000 in excess. So we are good. We are golden. So no problem here. Okay. Now let's say that the stock keeps dropping, and let's say the stock drops to 140. So stick with me. This is super important. This is what very few traders who are trading on margin understand, how this maintenance margin works. So now your portfolio is worth $14,000, right? You have 100 shares times $140. Again, we are calculating how much is the maintenance margin that we need. And this value, the 0.25, again, it's 25%. Your broker might actually maybe require 30% or 35%. So you need to understand how much it is. Okay, so if we are taking this times 25, we are ending up at $3,500. Okay, so this here is, again, the maintenance margin requirement. Let's see if we are still golden or if we are getting a margin call here. So now the portfolio is worth $14,000. We have borrowed $10,000 from the broker, so we have to pay this back. This is our loan. This is the margin, minus $3,500, and we are still good. We have $500 in excess, so we are still good. No margin call yet, but here it comes. So let's say the stock drops to $120. So again, now your portfolio is worth $12,000. We're taking the 0.25, $3,000. And this is now the maintenance margin requirement. Are you with me thus far? Super important that you understand it. Did you know that? Let me know in the comments if you knew all this or if this is new information here. So let's talk about it. Now we have the $12,000 is your portfolio minus the $10,000 loan from your broker that you took out in the very beginning when you bought the stock for $200, right? Minus $3,000 maintenance requirement. And what is happening? Oh, now it is $1,000 negative, okay? So what happens when it is $1,000 negative? Let's actually mark this in big red so that you know here with the excess, we were good. Let's mark this in green. And also with this excess, we were good. Let's mark this in green. No problem here. But now let's talk what happens when you are negative. So you see, because you still have to pay back the whole $10,000 loan. This is when you are getting a margin call. So what is a margin call? I mean, just technically, it is a demand from your broker to add money to your account or to close out your positions, right? So that you can pay back the money that you own the broker to bring your account back to the required level. So if you get a margin call, it's typically an email that the broker sends you, and make sure that you're not ignoring this. So how do you respond to a margin call? Well, you have two possibilities. Number one, you could sell your position. What would happen if you sell your position? Well, again, it is $12,000 is your portfolio worth right now. So the stock is trading at 120. So you have to give the broker back $10,000. And this means that right now you have $2,000 left in cash in the account. And again, since you are trading on margin based on your initial $10,000, this means that now you have an 80% loss, even though the stock dropped only 40%. Okay, what is the other possibility? The other possibility is that you send the broker more money. Okay, so the question is, how much time do you have? It really depends on your broker. Let me show you example number one. Example number one is Tastyworks, and you see maintenance calls are typically due 3 business days after the call is issued. So you have 3 full days. That's not at all. But you see, Tastyworks reserves the right to require maintenance calls to be met sooner. So pay close attention to your email, because in the email, they might tell you you only have a day or 2. Now, very, very important. Who here is on Interactive Brokers? If you're on Interactive Brokers, you need to understand this margin call. When the balance in a margin account falls below the maintenance requirement, the broker can issue a margin call, blah, blah, blah. And here's the important thing. There are no margin calls at Interactive Brokers. What? What does this mean? Well, let's go back here to our handy dandy notepad. So how much time do you have? We talked about this. This would be anywhere between 24 to 72 hours. Typically, again, check with your broker. So what happens if you ignore the margin call, or if you're with Interactive Brokers? If you do not meet the margin call, your brokerage firm can close out any open positions in order to bring the account back up to the minimum value. And your brokerage firm can do this without your approval, and they can choose which positions to liquidate. Now, as you can imagine, this is the worst case scenario, because they just choose any of your positions. So in our example here, right now, we only have 1 position. So it's super easy for the broker to choose. But if you have multiple positions, you have to be super careful, because now you lost control. So long story short, what does this mean? It means never, ever ignore margin calls. I mean, do something, either sell your position or send the broker more money. Now, super important, you might see it here also, right? The fastest way is to send a wire transfer. Don't do ACH, don't send a check, because the broker doesn't care when you initiated this. They only care when is the money back into the account. Okay, to understand margin is super important. Now let's very briefly talk about portfolio margin, and we don't spend much time on this. So portfolio margin is margin for bigger accounts. And you see, every broker is using here a different measurement. Some brokers allow you to apply for portfolio margin when you have $125,000, could be as much as $175,000, or maybe even $200,000. It really depends on your broker. So why is it more here? Well, it usually gives you a much, much, much larger margin. Previously here, we had the $10,000, or let's say $100,000 would turn into $200,000, So this is with the so-called regular margin, or this regular margin is also called Reg T margin. I don't know what the T stands for, it doesn't really matter, but this way you get an idea. This is the regular T margin. Now, if you have portfolio margin, $100,000 could turn into up to $610,000. This is with portfolio margin. So as you can see, you get much more leverage. And as you already know, leverage is a double-edged sword. Again, why do I say up to $610,000? Well, there's a quite complicated formula. I got this here from TD Ameritrade. You see, with portfolio margins, stocks and options are tested by hypothetically moving the price of the underlying between plus and minus 15%. The price ranges are then divided into 10 equidistant points, and the loss or gain on the position is calculated, and blah, 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 blah. What does it mean? It's complicated, and what it basically means, it is subject to change all the time based on volatility. So this is why portfolio margin is super tricky. It is super dangerous. You need to know what you're doing here. But as I said, I promise you that I'll tell you things that you need to know. Now you know what margin is. You know the advantages of margin trading. And this is always the exciting part. This is what most people are talking about. Yay, it's so fun. You also know the dangers. And please, 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 if you still do not understand these maintenance requirements, please watch this video again, pause it, rewind it. This is where I gave you many examples here. When you get a margin call, do not ignore it. It's the worst thing that you can do. Well, if you're with Interactive Brokers, they're not issuing any margin call. They immediately liquidate this. And you also have a better idea of what portfolio margin is. If you found this helpful, give me a thumbs up, and I'll also have some other videos popping up right now. Take a look at these so that you know how you could use margin in your account. All right.